Hello, this is Dale. In this video, what I'm going to be showing is how to trade a list of financially strong stocks using credit spreads to profit handsomely. This is my 2020 list. The year-end returns have just been publicly made available, and usually this list is about 20-25 companies. It's a small market basket, but the nice thing about the financially strong stocks is the old adage, the bigger they are, the harder they fall. Well, that's true with the financially strong stocks because they outperform the market, so they grow quickly, but when they fall quickly. This gives a very powerful list to trade credit spreads, not only when the market is going up and the stocks are going up using bull puts, but when the market is going down and the stocks are going down using bear calls to profit on a consistent basis. I've been a trader for over 4 decades, hedge fund manager, and I am the founder of what I believe is the very best educational options trading website available today, and that is www.optionsinfinity.com. I also release to my members what I am trading as far as credit spreads is concerned, and it has been doing very well, and I'm going to show you that towards the end of this presentation. The nice thing about financially strong stocks is they do outperform the market, and they've outperformed the market since I've been looking at this for the last 20-25 years. What I'm looking for is companies that have the best cash from operations, not the net income, but the cash from operations. That's the money, all the money the corporation made. Because when they report earnings per share, that is not all the money the corporation made. They have to come back in and add the depreciation, which they took out, so they didn't have to pay taxes on it, but they actually made that money. And they have to make any changes in working capital to show how much money they made. And what I'm looking for is the best of the best with cash from operations, because the corporations that have the most money have the most options available to them. They can expand. They can increase their research and development. They can add manpower. All this is available to the corporations that have the most money. I'm going to then share with you my 2021 financially strong stock list. And this right now is 21 stocks. And then I'm going to show you the best way to trade these using credit spreads. In this chart, what I'm showing you is just an example of 4 financially strong stocks: Google, Amazon, Visa, and Home Depot. And I'm comparing them to the overall market. The black line here is the S&P 500. So this is how the market has performed over the last 10 years. It's had a nice little gain, okay? But you compare that to the financially strong stocks, and you see how Amazon has outperformed the market about 1,500%. Visa is right behind it, and then Google and Home Depot are right behind it here, returning about 3 times what the market has returned over that time period. First thing I do is I choose the 10 most profitable market sectors. Then I'm looking for the corporations within that market sector that have positive trending cash from operations for the last 4 to 5 years, not just the flash in the pan. I want to see a corporation that is positively trending with the best cash flow. And this, like I mentioned earlier, this list usually is about 20 to 25 stocks. This year, it's 21 stocks. Now, there are 7,500 public available corporations out there to choose from, but I think if you have a small market basket to trade, you're going to do better because you really get to know those stocks and what the charts are telling you. It's very difficult to look at 7,500 and pick out profitable trades. These are the market sectors, and you'll notice that within these market sectors, communication services, for example, there's 5 industries within that market sector, and then there's usually about 20 stocks within each one of the industries. What I'm looking for is the top 10, and then I'm looking for the best of the best within that industry. We usually start out by looking at, I get this information from Yahoo Finance, and you can see right here, consumer discretion outperformed the market, and you can see over the last year. Let's start over here, and this was the coronavirus scare. They both dropped, but then they recovered better than the market did. That's the first step. I want to pick a market sector that is stronger than the rest. Then I want to pick the one that has the best cash flow. Cash is king. And what I was saying earlier is on the net income statement or the earnings per share, they're not telling you the whole picture. Net income is taken by, you have all the revenues, you take out the expenses, you take out the depreciation, which is an allotment the government gives corporations to invest in themselves. But then they give you a tax credit, a certain percent per year. Well, the corporation actually made that money, but they allow them to take that off before they pay taxes. That's the net income. That's not the total amount of money the corporation made. So when they report earnings per share and you see the earnings season and so forth, that's not the total story. Businessmen know that the total story is cash from operations, which is taking the net income, adding this depreciation back in, making any changes in working capital to give you cash from operations. The corporations with the most cash perform the best. This is data that I take from Guru Focus, and this is just the last 4 years for Amazon. And you can see, the cash statement, cash flow statement starts with the net income. It makes any changes in depreciation. You can see that that's a large number. So usually a very large number. This year it was almost as high as the net income. $25 billion is added back in. The corporation actually made that. So the cash from operations for Amazon was 18 billion, 30 billion, 38 billion, and 66 billion. They have done extremely well. This is the kind of corporation that will outperform its competitors. This is the 2021 financially strong list. The ones that are in red are new to this list. Last year, there were 20 stocks on here. So let's see, the new ones, 1, 2, 3, 4, 5, 6, 7, 8, 9. We got 9 new ones. So there were 8 that were dropped off the list. Corporations like Caterpillar, Cummins engine that had a tough year last year with construction being down. So I update these every year to have a fresh list. Doesn't usually change a lot. This year, it did have quite a few new ones put on here and quite a few old ones dropped because of the tough circumstances with the economy in general. Now, what I would suggest is what I use. You can either write all these down, you can pause it right here and write all these down, or you can use a snippet tool or a screen capture and just capture this so you have it for later reference. This is my market basket for the year. These are the only stocks that I follow. The average profit in 2020 for the financially strong stocks, just by buying them at the beginning of the year and holding on to them, they return on average 42% versus 14.2% for the market returns. Relatively good returns last year. Even though the coronavirus, we had that big scare, the market rebounded quite nicely. And the market returned 14.2%, which was really good. Financially strong stocks 4x'd that return. Now, I have to say that past performances is no guarantee of future results. However, this has been the way the financially strong stocks perform for the last 20 years. And that's when I first started watching it. So I don't know, it probably performed better than that even further back. Now, take it one step further. Profit trading vertical credit spreads totaled 265% of margin. Using credit spreads, bull puts, bear calls, occasional iron condor on the financially strong stocks returned 265% versus 42% of just buying the stock versus 14.2% by just going with an index like the SPY, Standard & Poor's 500. Once again, past performances is no guarantee of future results. Quickly, let me just go over a bull put spread. The operative word there is bull. This is a bullish strategy when you feel that the market is going to be going up. What you do is you sell. You're going to sell a put out of the money, and then you're going to buy one further out of the money for protection. Now, you can see that you're quite a ways out of the money. So you can profit when the stock goes up, when it goes sideways, and even if it goes down. So you've got 3 ways to profit unless it goes all the way through here. And that's why we always buy one back here for protection to protect against the catastrophic failures. The way I manage the trades, we never get even close to doing that. That is a bull put. Bear call is just the opposite. What we're doing is we are selling a call out of the money and buying one further out. So we are sellers. We are sellers. Okay. And when you're selling an option that's out of the money, it's only made up of intrinsic value or time value. The longer you hold on to that, the more theta decays and that premium goes into your bank account. A bear call is when you buy a call, you sell the call, and then you buy one further out for protection. Once again, you can profit when it goes down, goes sideways, or slightly up. Time is in your advantage. That's the key to credit spreads. Now, go one step further. We don't want to just put a credit spread on. We want to have a good idea of the direction that the stock is going. I use three very powerful trading tools. First one is the regression channel, then measured moves. Measured moves tell me what the trend is, then Fibonacci extensions tell me when the stock might be overextended and it's time to take profits. In this chart, what I'm showing is the regression channel. The regression line is calculated by 50% of the price above and 50% of the price below to give you the regression line. And then what you do is you take plus or minus 1 standard deviation and then plus or minus 2 standard deviations. Well, what's key to this is that 95% of all prices will be contained within the plus or minus 2 of the regression channel. So you really know when a stock is overbought or oversold. And that then becomes a good time to get prepared for a bear call when it reverts back to the mean, or a bull put when it reverts back to the mean. Now, this is just a chart showing that the regression channel is based on probability with a plus or minus 1 standard deviation, 68% of all prices contained there, and plus or minus 2, 95%. That's a powerful tool to know when a stock is overbought or oversold. This is a chart of Caterpillar, and you can see the regression channel has been placed on here. The black is the regression line, then the green is the plus or minus 1, and the gold is plus or minus 2. And you'll notice that the Caterpillar came up to the plus 1, down to the minus 1, up to the plus 2. Okay. Having a small market basket, you really get to know where stocks react. Do they react to the plus or minus 1, or do they react to the plus or minus 2? This is a very powerful tool. The regression channel is one of the most powerful tools I learned, and I've been applying it for about as long as I've been trading. Measured moves is also powerful. It helps to define the trend. A bullish measured move is that the stock is coming down and makes a low, then comes back up, pulls back, but makes a higher low, and then crosses the B point to a higher high. That is called a bullish measured move. The classic definition of an uptrend is higher highs and higher lows. Higher highs and higher lows. For a bearish measured move, stock is going up, you get a high, pulls back, tries to get up to the high again, doesn't do it, makes a lower high, then comes down and makes a lower low at B. That's the classic definition of a downtrend. Lower lows and lower highs. Now, not only can you determine the trend from a measured move, but once you have a measured move, you can apply Fibonacci extensions to that to see when a stock price might be a little bit overextended and maybe it's time to take profits. First, let me show you that Caterpillar chart. Here was the regression channel. Here's two measured moves that occurred. Here was a high, then it came down, and then tried to make a new high, but didn't. It made a lower high, then it made a lower low right here, and that is a bearish measured move. This is a bullish measured move. It goes up, 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 up. This is the high, then this is a low. It's a higher low, and then it makes a higher high right here. This is the time to put on a bull put spread. This is the time to put on a bear call spread. Okay, Fibonacci's. Fibonacci derived a number sequence where he adds the current number to the previous number to get the next number in the sequence. Like 0, 1. 0 plus 1 is 1. 1 plus 1 is 2. 1 plus 2 is 3. 2 plus 3 is 5. Okay, that's the number sequence. If you now divide any number by the following number, you'll get 0.618, which is called the root Fibonacci ratio. This ratio is seen throughout nature. Stems on a flower grow to this ratio. Your bones in your body grow to this ratio. If you take the length of your forearm and divide it into the length of your hand from your wrist to your index finger, you will get 0.61. All your bones grow proportional to the Fibonacci ratio. It's a very powerful thing. It's seen throughout nature. So doesn't it make perfect sense that the market, which is fueled by human nature, fear and greed, that the Fibonacci's would help you to determine when a price is overextended. Mathematicians later took this root Fibonacci ratio, took the square of it, and then when you take the inverse of that, you come up with 1.27, 1.61, and 2.61, which I use to determine when a stock is overbought or overextended. Okay, so now we've got the regression channel. We've got the measured move. And once we have a completed measured move, we can put in the Fibonacci ratios. Usually, when it gets to the 127 and blows right through there, it's going to go to the 161. That's exactly what happened here. Got to the 161, though, and the brakes were applied, and then back up it went. Not only were the brakes applied at 161, but it was down to the -1. So this is a great place to take profits from your bear call that was put on back up here. This is the measured move to the upside, and here is the confirmed measured move, and here is the Fibonacci 127, and it's amazing how close this comes to showing where you've got highs and lows. And I didn't believe this at first, so I just practice and practice and practice and put these on a lot of different charts and convince myself that, wow, it looks like magic, but these Fibonacci extensions pinpoint where you should take profit. Okay, so it appears like now with all this information, this would be a good place to put on a bear call. And this would be a good place to put on a bull put. Well, we did just that. We did just that. When it made a measured move right here to the downside, we sold the 19 March, we want to go out about a month, the 2010 call, and bought the 2020 call for $1.50. Remember, there's 100 stocks in a contract, of 100 options in a contract for an option. So if it's quoted at $1.59, so actually to buy one of these options is $159. We held on to it. It went down in our direction, and this was a good place to take profits. We bought back this option on 127.21 for 80 cents profit. I never let this go all the way to expiration, because using the Fibonacci's, you can pinpoint when that move might be overextended. So why not get out and take your profits rather than wait? If we would have waited, a lot of those profits would have been eroded. This was a 50% profit in 6 days. I'll take that any day. Now we had a measured move here, and on 2/16 of 21, we sold the 21 May, 165 put and bought the 175 put and the 165 for protection for $1.80. When it hit the 127 right here and very close to the +2 on the regression channel, I took profits, even though there was 75 cents left on the table. That was a 58% profit in 1, 2, 3, 4, 5, 6, 7 trading days. This is a positive expectation trading strategy using credit spreads with financially strong stocks. In this chart, what I'm showing you is 2 years of returns, and this is an average return. It's an average equity chart. You can see that we don't have all winners. We have losing streaks. This was the coronavirus scare. We had trouble getting out quickly enough, and we lost in the first couple of days, but then quickly got all that back. This is returned over 2 years, very close to 600%. It's an awesome return based on margin. Now, the strategy I just disclosed to you has a positive expectation. And I'm going to teach you that strategy, and I'm going to work with you. But the biggest thing is to become a real successful trader, you're going to need a mentor. Here's the strategy. I'm going to show you the strategy. I'm going to teach you the strategy. Then once a week, we're going to get together for an hour for a members meetup. And I'm going to show you why we put on these trades, how I'm managing the trades, what I'm looking at to exit the trade. And then there's plenty of time for questions. A mentor will help you not only to solidify the strategy, but help you to reduce the time before you become a success. What I'd really like you to do is join me, join our community. You go to my website, www.optionsinfinity.com. We're in our 10th year where I've been publicly releasing option strategy, vertical spreads when I make a trade. So you not only get that list, you get text and email alerts when I make a trade. Every week we get together. Once a week I send out a commentary on what we're doing, how we're doing. You get our entire master class suite, which shows you how to trade Forex, how to trade weekly credit spreads, how to trade monthly credit spreads. This is what I believe is the very best option education website available today. The price for that is very reasonable, and it's recurring. So and it recurs once a month. So you cancel at any time. If you feel like you've got this and you're ready to go on your own, I really enjoy when my members do that and they send me an email and say, Dale, I'm ready to go on my own. You know, I love your community, but I'm gonna go on my own for a while. And my response is, good luck to you. I hope this works. You're welcome back at any point in time. I hope you all take advantage of this and join our community. Thanks for watching this video. Bye-bye now.